All right, so you want to really understand this whole investing versus speculation thing, right? And you've sent in some really interesting stuff for us to dig into.
Yeah, some great material to really get to the bottom of.
So our goal today is pretty simple. We're going to really try to clarify these concepts, especially with the help of Benjamin Graham, so that you can walk away with a solid framework for making smarter financial decisions.
Exactly. We want to give you the tools to tell the difference between, thoughtful investing and, well, the more impulsive side of the market, let's say.
And our main guide for this deep dive is going to be Benjamin Graham himself with his classic work, Investment versus Speculation, which is, a cornerstone of The Intelligent Investor. But what's really cool is that these ideas weren't even new when that book came out. Graham had actually already laid out these principles back in 1934 in Security Analysis. Talk about ideas that have stood the test of time.
They really have. And I think it's important to remember the historical context here. Graham was writing in the aftermath of that huge market crash in the early 1930s. Back then, most people thought stocks were just risky gambles. You can imagine that. A time when bonds were seen as the only truly safe investment.
It's almost like the opposite of how we think today, isn't it? But back then, Graham was actually pushing for a more nuanced view of what could actually be considered, investment worthy.
Right. And it's funny because if you fast forward a few decades, the pendulum had swung so far in the other direction that the word investor seemed to apply to anyone who bought a stock no matter what they were actually doing. Graham even points to a headline from 1962. Small investors bearish, they are selling odd lots short.
Selling short.
Yeah.
So they didn't even own the shares they were betting against.
Right.
That's wild. And then just a few years later in 1970, this same financial publication ran an editorial criticizing these same investors for being reckless with their buying. Talk about a head scratcher. Reckless investors. It's almost like saying spendthrift misers, like what Graham pointed out. The term investor had become so broad that it covered everything from, careful long-term holdings to basically gambling with borrowed money. This was a huge shift from just a couple of decades earlier, like in 1948, when surveys showed that over 90% of people were wary of stocks. They saw them as either too risky, like not safe, a gamble, or just something they didn't understand at all.
And the irony that Graham highlights is that stocks were seen as most dangerous when their prices were actually low and arguably offered the best potential for long-term gains. But then as prices climbed to levels that you could argue were much riskier, those same stocks magically became investments and everyone holding them was suddenly an investor.
It really shows how easily our perceptions can get detached from actual value and risk, doesn't it? Now, along with Graham's work, you also share some commentary by Jason Zweig on this first chapter of The Intelligent Investor, which adds a really valuable modern perspective to these timeless ideas, don't you think?
Absolutely. And one of the things Zweig stresses right from the start is that before you even think about buying any asset, the most important thing is to understand yourself. It's not just about what you're buying, but who you are as you approach the market.
Okay, so let's get down to the nitty-gritty here. What exactly was Graham's core definition that separated investing from speculation?
Well, the definition that Graham stuck to consistently for over 38 years was this. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. I mean, that's really the heart of it. It's about doing your homework and having a reasonable expectation that you won't lose your initial money and that you'll make a decent profit.
So basically, if it doesn't meet both of those criteria, safety of your principal and a good return based on solid research, then Graham would call it speculation. It really makes you think twice about how casually we throw around the word investor these days.
Exactly. And Graham was really concerned about this. He felt like it misled people and could lead to, some pretty serious financial trouble for folks who didn't really understand the risks they were taking. He felt that financial professionals had a real responsibility to make that distinction clear.
Yeah, it's like saying that buying a lottery ticket is investing in potential winnings.
Yeah.
It's just not an accurate representation of what's happening.
Right.
Graham saw a similar kind of misrepresentation happening in the stock market.
And that blurring of the lines can have some, real-world consequences. Graham even pointed out that some brokerage firms got into trouble by, including speculative stocks in their own capital reserves, which is pretty ironic.
Yeah, that really highlights how important this distinction is even for the professionals. Now, Graham also makes a really interesting point about investing in common stocks specifically. He suggests that a completely risk-free approach might not even be possible anymore.
Yeah, he acknowledged that in most market environments, there's going to be at least some speculative element to owning stocks, meaning that there's always a chance of, market downturns and potential losses. So for the intelligent investor, the key thing, according to Graham, is to keep that speculative component small and to be prepared both financially and mentally for those inevitable drops, whether they're short-term or longer-term.
This brings us to his perspective on speculation itself, which is actually more nuanced than you might think.
Yeah.
He didn't see all speculation as bad, did he?
No, not at all. Graham understood that some level of speculation is kind of unavoidable in the stock market given all the uncertainties and the potential for both gains and losses. He even suggested that there could be such a thing as, intelligent speculation. However, he also warned against unintelligent speculation in a few key ways.
So what did he consider to be unintelligent speculation?
Well, first and foremost, it's speculating while thinking you're actually investing. This is where that lack of thorough research and the focus on quick profits can really get you into trouble. Secondly, it's engaging in serious speculation without the necessary knowledge or skill or understanding of what you're doing, basically treating it like a game but with real financial stakes. And thirdly, it's risking more money than you can realistically afford to lose on these speculative ventures.
All pretty clear red flags there. He also called out a few specific activities that he saw as inherently speculative, right?
He did. Graham was really against margin trading, especially for non-professionals. He felt that anyone using borrowed money to invest was by definition speculating. He even thought brokers had a responsibility to advise their clients about that. He also put things like buying hot stocks or, making those impulsive buys based on tips and rumors squarely in the category of speculation or even outright gambling.
Yeah, those hot stocks can be so tempting with their promise of quick and easy returns, but Graham saw right through that. And he even offered some advice for people who couldn't resist dabbling in speculation, right?
Yeah, he had a pretty interesting suggestion. He said that if you really feel the need to speculate, you should only allocate a very small percentage of your capital. And he emphasized the smaller the better into a separate fund just for speculation. And crucially, he said to never add more money to that account just because the market is going up and it seems like you're making money. That's actually when he recommended, thinking about taking some profits out. And he was very clear that you should never mix your speculative and investment activities, both in your accounts and in your mindset.
Yeah, keeping those two worlds totally separate makes a lot of sense. Now let's shift gears a bit and talk about Jason Zweig's commentary and how he views the essence of investing. He uses a really cool analogy to describe it.
Yeah, he connects the word invest to the Latin vestire, which means to clothe or surround or envelop. And he uses that to illustrate that investing is kind of like wrapping yourself in a financial asset and holding on to it. But to do that responsibly, you need a strong foundation of confidence based on your own careful analysis, not just on what everyone else is saying or doing.
It's a process that plays out over the long term, requiring structured decision-making and thorough, consistent analysis.
Yeah.
Definitely not about those quick decisions we make on our phones based on a headline we saw.
Exactly. And Zweig points out that the returns you get from true investing are what he calls intrinsic, like the interest payments from bonds or the earnings and dividends from stocks. A true investor understands that when you buy a stock, you're buying a piece of a real business, and that the long-term success of that stock is tied to the actual health and profitability of that business.
And he says a key part of that investor mindset is how they react to price swings.
An investor who's thinking long-term about the underlying business value doesn't buy a stock just because the price is going up or sell it just because it's going down. They look beyond those short-term fluctuations to assess the fundamental long-term worth of the business. Like, what is this actually worth to me over time, and how long am I willing to hold it to realize that value?
It's pretty different from the speculator's mindset, which Zweig also explores by looking at the origin of the word speculate.
Yeah, he connects it back to the Latin word speculum, meaning mirror, and specula, meaning watchtower. So there's this idea of the mirror suggesting you should be looking at your own motivations and your risk tolerance and the watchtower, implying that you're trying to predict the future, which in the short term is inherently uncertain.
So it implies a level of thoughtful consideration, both looking inward and outward. But Zweig contrasts this with how a lot of speculators actually behave.
Right. He argues that in reality, many speculators skip that self-reflection part and don't pay much attention to those long-term fundamentals. Instead, their main motivation often boils down to just one thing. Other people are buying. Their focus is on short time frames, months, weeks, even days, or minutes, and their potential gains are what he calls extrinsic, meaning they depend on things like popularity, price momentum, and what they think someone else will be willing to pay for that asset in the near future. So their question becomes, What is this worth to someone else right now? And how quickly can I sell it to them?
And Zweig lays out this really vivid picture of the emotional roller coaster that a lot of speculators go through.
He calls it the behavioral life cycle of the speculator, and it starts with doubt, then moves through hope and confidence to complacency and greed, and then inevitably crashes into fear and despair before eventually fading back into doubt and starting the whole cycle over again. It's this constant back and forth of trading based on hunches and chasing those quick profits.
Sounds exhausting, and probably not that profitable in the long run for most people. Zweig also acknowledges that there's this natural human attraction to speculation, though.
Yeah. He recognizes that the urge to gamble is kind of built into us, and speculation offers that exciting possibility of, hitting it big even if the odds are against you. And while the odds in the stock market might seem better than in a casino, Zweig warns about the dangers of getting addicted to that rush and losing sight of your long-term financial goals in the process.
He also talks about this idea of the silence of the losers, which could make things even more deceiving.
Right. People who lose big in speculation are often too embarrassed to talk about it. Meanwhile, the winners tend to shout their successes from the rooftops, creating this distorted view where it seems like everyone's making easy money. So people get drawn in thinking it's a sure thing without really grasping the risks. It's like only hearing about the lottery winners and forgetting about the millions who bought losing tickets.
Makes sense. And Zweig actually offers a suggestion for people who feel that urge to speculate, kind of like a controlled outlet.
Yeah, he calls it a mad money account. The idea is to set aside a very small amount of money, no more than 5% of your total assets, and if you happen to make some lucky bets, great, you might get a decent return, but if it all goes to zero, it won't cripple you financially. He even suggests keeping this account completely separate, maybe even at a different bank, and absolutely never adding more money to it no matter what happens.
That seems like a pretty smart way to satisfy that urge to gamble without putting your long-term financial well-being at risk. Now, the material you sent in also highlighted a really clear example of widespread speculation that happened pretty recently, the 2020-2021 period during the COVID pandemic.
Yeah, that was a fascinating case study of speculative behavior in action. You had this really unique convergence of factors, job losses, lockdowns, zero interest rates, government stimulus checks that basically created the perfect storm for a surge in online trading. Platforms like Robinhood and Moomoo saw an explosion of new accounts and trading activity.
The numbers were crazy, weren't they? Millions of new accounts opened in such a short time, and the rate of trading just skyrocketed. Zweig even mentions one Robinhood user who was averaging like 92 trades per day. 92? That's not investing, that's like a full-time job. A very stressful one at that.
Yeah, it was a really intense period. People had more time on their hands, some extra cash, and they were pouring it into the markets. And for a while, it seemed like everything was going up. You could make money on solid companies, struggling companies, even joke cryptocurrencies like Dogecoin saw insane gains.
It created this surreal atmosphere where traditional ideas about, value and analysis seemed to go out the window. Like, why bother researching a company's financials when prices were just going up no matter what?
Exactly. Zweig quotes Amy Rogozinski, the founder of the Wall Street Bets Forum, who said that a lot of the members felt like careful analysis was pointless and that they were just using volatility as a form of entertainment. And then you had those stories about people like Dave Portnoy picking stocks based on Scrabble tiles, or that young couple on TikTok whose strategy was literally just buying stocks that were going up and selling them when they stopped.
And who could forget Danny Tran and his now infamous line, "I don't know what the F I'm doing, I just know I'm making money."
Yeah.
That really captured the spirit of the moment, didn't it?
It did. It really showed how disconnected the price movements were from any real understanding of the businesses involved. And this led to the rise of those meme stocks like AMC, Bed Bath & Beyond, GameStop, Virgin Galactic, where the prices were being driven more by social media hype and the fear of missing out than by the actual value of the companies. Like, Zweig quotes Richard Dawkins saying, "The word meme itself comes from the Greek for something that is imitated. Everyone else was buying, and that was enough."
But as we all know, that bubble eventually burst.
It did. And while a few people who got in early made a lot of money, the vast majority of folks who jumped in late ended up buying at inflated prices and selling at a loss when the hype died down and the fundamentals reasserted themselves. Zweig has a great line that sums it up. Whenever making money becomes effortlessly easy, keeping it is about to become extraordinarily hard. The big takeaway is that easy money often leads to reckless behavior and eventually losses for most people.
A timeless lesson for sure. So as we wrap up this deep dive, let's go back to that core distinction between investing and speculation.
So basically, investing in the way Graham describes it is a long-term approach based on thorough analysis with the goal of preserving your initial capital and earning a reasonable return based on the intrinsic value and health of a business. Speculation, on the other hand, is usually more short-term, focused on price movements and what you think someone else will pay, often without a deep understanding of the asset itself.
And as Zweig emphasized, it all starts with you, the listener, and really understanding who you are as you approach the market.
Right. Before making any financial decisions, it's crucial to think about your goals, your risk tolerance, your level of understanding of the market. Ask yourself, are my actions aligning with Graham's idea of thoughtful investing? Or are they leaning more towards the speculative behavior we've been talking about?
That's the key question for you to ponder. Given what we know about speculative bubbles and the principles of long-term investing, how could understanding this difference shape your financial decisions going forward? How can it help you avoid the temptation to chase those quick gains that often lead to losses?
And as you think about that, you might want to explore some of those key concepts we touched on in more depth. Like, what does thorough analysis really involve? How do you actually assess the safety of principle? What are the different ways to value a business based on its underlying fundamentals? These are the tools that can help you move from the world of speculation to the more grounded and potentially more rewarding world of intelligent investing.
Food for thought. Thanks for diving deep with us.
You got it.